Good morning, everybody. Happy Tuesday. Welcome to Set the Market. Hope everyone's doing well. We are looking at, I think things starting to intensify a little bit here in terms of volatility. We've talked about this now for the past couple of weeks. I think we're finally at a point where the rubber could meet the road. So that's what we are going to talk about here now. Just making sure audio and visual is good. If you guys can just quickly give me a confirmation. Okay, very good. Perfect. All right. Excellent. And then we're going to get started here. I would say right now. If you're here for the first time, good morning. This is our Set the Market morning call. Serge Berger here from thesteadytrader.com. We're going to look at a few things here right now that I think are pertinent for the week that still very much lies ahead. Obviously, it's only Tuesday. We've got NVIDIA earnings on Wednesday, so that'll be the reaction we're going to see to that in cash markets on Thursday morning. So I think it's important to understand where we're at right now. So let's just get to it. Few things we're going to go through. NVIDIA, as I said. I do want to spend some time on software stocks, which we've been highlighting and talking about through the lens of the trend breaks and the bearish momentum now for 2 months. So nothing new. It might be new on TV. It's not new from what we've been talking about. I want to highlight the financials, JP Morgan, the sector, and then we do have to look at yields, which I know is always a bit of a boring topic for retail investors, but it's also the most important thing to watch. So anyway, let's get to it. First of all, let's just remind ourselves where we are in terms of performance. This is the year-to-date performance of a bunch of stuff together. Essentially, if you just focus in the bottom right-hand corner, and I need to make this a little bit smaller so I can actually see it over here. So you can see Max 7 stocks down 6.6%. The only Max 7 stock that's still hanging in there for the most part is NVIDIA, and that one's about to report earnings, as you know, on Wednesday. We'll look at some of that stuff here in a minute. But again, keep in mind, this is not a news story. We've talked about this this sector market leadership changing. It's something that very few people had any interest in listening to last year. The problem is, these things start slowly and it all comes at once. And that's why it's so important to be aware of when trends change and ultimately when momentum changes, and ultimately how that moves into trend changes. So I know a lot of you guys that have been here for a while, you know this, and I think a lot more people are going to learn it over time by giving back a lot of gains that they've had over the past, that they've accumulated over the past few years. So that's what's going on there. In terms of sector performance, and we're actually going to do a special session on this tomorrow. I know Christian has the link. I'll show you this in just a second, but let me just quickly show you, just if you were to look at just equities themselves, I just want to remind you once again of this. I try to remind people every day, which I think is necessary at this point. But just, again, this is the kind of thing that we want to make clear to people last year, and here we are, and most people, 99% of people missed the boat. The energy sector is up 23.3% on the year. Let me repeat that. 23.3% on the year. You know how many people own energy stocks? No one. No one owns energy stocks. That's why it's so easy for it to go up. Financial stocks, which everyone was bullish on, including your favorite CNBC personalities, they're down 7.4% on the year. That can change, but that's where we are right now. That's the mark. Financial stocks are down, and of course, tech stocks are down 3.4%. So pretty much everything that a lot of people were yapping about on TV that's going to do great this year is essentially going the opposite way. Now, again, obviously, we're only here end of February. The year is still young. So this is not an end-of-year comment. It's just the point is when you have this dramatic kind of divergence of performance, it can hurt, right? And that's what's going on. So where does it lead us to? Well, it leads us to understanding what's going on in software and why that might just be the beginning of a broader rotation. Well, it's actually a broadening of the rotation out of the Mag 7 complex, which is not a bearish call on that stuff. I want to be one more, because we get hate mails every day saying, oh, Serge is bearish. I am not bearish AI. I really am not. What I am bearish on is the constellation of the market cap concentration of the indices. It's just not sustainable. Not in a straight line, but ultimately. So let me just show you a couple things here so you can kind of see what's going on. So let's just get rid of these moving averages. They're really useless for this. So this is the software complex, okay? And this is where now I see a lot of people getting very fancy, drawing simple lines. This is the IGV ETF. You may have heard about it. It's become a financial TV regular ticker being mentioned every day because it's now finally blowing up people's portfolios. So this thing here, since it basically topped out in autumn of last year, is now down a cool 35%. You may not care. The problem is all the momentum stocks, the snowflakes, the CrowdStrikes, all those funky names. And I say funky, I'm not saying they're bad companies, but they were being chart chased. They've all now essentially completely collapsed. Now, the problem with drawing a simple horizontal line is that it doesn't really give us any real perspective of where we are. So what I'm like to share with you is what a process actually looks like, and this is why we have our momentum and trend indicators. So if you look at this very closely, the real trend change from a investing perspective happened somewhere between the 30th of December, or call it somewhere between the first and second week of January. Okay, within there, that's when the green background color turned into black background color. Right now, that's just factual. I'm not making this up. Since that happened, which means that if I own this sector or this software group, I'd want to clip some of it, maybe sell a third, 2/3, all of it. Maybe that's a risk management question everyone has to ask for themselves. Has to answer themselves. It means we have to, because the trend is changing. It's no longer bullish trend. It's now neutral trend. And so since that happened, we're going to take the midpoint here. These softer stocks on an ETF level are down about 26%. That's a lot, right? And now it's actually in a bearish trend. And we'll talk about this in our ETF, in our market remember session in about 10 minutes or so. So we'll see market remembers over there and give you more detail on that. But what's also important is to understand where the trend changed, the momentum changed. And the momentum, which is the more near-term stuff for the software space, actually turned bearish literally on New Year's Eve, right, on December 31st. And you can see that the IGV ETF is down 27%. So if you're getting your information from Financial TV, and this is not, by the way, I'm not bad-mouthing Financial TV. I'm just telling you there's a lot of lagging effects on those kind of things. Then you're kind of behind the eight ball, or one is behind the eight ball, and just making sure, we need to make sure that we have a process, because TV doesn't give you a process. It gives you news, which is typically, kind of too little, too late. So that's what's going on with these stocks. And again, if you are a market remember, we'll go into this in more detail. But I'll just give you a bit of an idea of what some of these major trend changes look like. So you look at something like IBM, which was down a cool 13% yesterday, right? That trend changed from bullish trend into neutral trend somewhere around about a week ago, right? It's not going to pick the top because these are major trend changes. These are multi-quarter, multi-year trend changes. But by getting out then, I would have avoided yesterday's calamity of down another 13, whatever we just said, percent. And I can show you a dozen of these, and they all look the same. So by missing the trend changes, investors typically give up a majority of gains they had during bull runs. And we don't want to do that. In fact, IBM, if I now go to a momentum chart on this, which of course is more short term, you can see the latest signal we received was a sell signal on the 4th of February. And since then, the stock is now down 22% from a momentum perspective in the near term. Okay. Next thing, I want to look at financials. But before we look at financials, I do want to just quickly remind you again, we call it the Great Rotation here in 2026. Last year, 2025, was, we called it the year of the trader because there's a lot of trading opportunities. This year, there's going to be great trading opportunities, no doubt about it. In fact, we're seeing some of them right now on the short side in software stocks for the past couple of months. But I think it's really just starting. And so this year is the year of the Great Rotation. But the Great Rotation also has a very specific sub-theme that we like to focus on. And that sub-theme is basically the rotation into a part of the market that is very closely tied to AI, but it's absolutely not AI. And so that rotation, which again, it's happening. I just showed it to you before, by the way. It's happening right now. And so if you want to learn more about that, I think it's one of the greatest capital rotations we've seen in the US equity markets in a long time. So if you want to learn more about that and how do we find these things, make sure you join us tomorrow, Wednesday, February 25th. For that. It's free. It's just our weekly educational session. We call it strategy session. So make sure you join that tomorrow to learn more about that. Because the risk right now is that portfolios are simply not positioned properly. That's our view. This is not advice I'm giving you. It's educational here. But we know where people are allocated and where they're not. And there's a reason why energy stocks are up 23% on the year and tech stocks are down 3 or 4, right? And Max 7 is down even more. So there's a very specific reason. It's a 27, 28% spread between one of the worst and the best sector. That is almost irreparable to make up throughout the course of a year. So the damage for a lot of people is just beginning, but it's kind of already, the nail in the coffin. So we want to make sure people are aware of what these trends are, at least by our view, right? So if you want to join us in that tomorrow, please join. Now let's talk about financials. Couple things. First of all, let's look at JP Morgan. I call it Mother JP Morgan. It's my alma mater. Just a little bit of perspective here. So the financial sector is down a lot this year. So far, JP Morgan's holding in because it's the balance sheet of basically corporate finance in the United States, and so I would watch these levels pretty closely where we're at right now. I'm going to give you this on a daily chart. If we look at this more from a process perspective, right? What's the trend? The trend in something like JP Morgan remains bullish. That hasn't changed, but we're starting to see bearish momentum. We're also seeing, and we'll save this for our Market Rover members we're going to meet with you guys in about 7 or 8 minutes over there. And we'll look at the financial sector a bit more, but we're starting to see signs of a serious trend change as well in the financials. And I'll give you, the chart that, again, most people don't really care about or care to understand. But I'm going to give it to you because it's so darn important. And that's yields, right? So yields pretty much across the curve. This is 2-year yield, so the yields of the TS Treasury 2-year note. The line in the sand for me is about 3.4%. I think if we break and hold below 3.4-ish, could be a touch lower. I think the equity market, broadly speaking, and it's already rolling over to some extent, is going to have a much, much, much more difficult time. So that's what we want to focus on here. Is watching these yields. It's the same thing on the 10-year yield. So basically this means buy bonds, basically, from at least on the short end. The 10-year yield is also starting to look weaker. But here you have a yield curve issue. So there's a lot of money still being spent, and that might cause the yield curve to steepen as opposed to just come down all the way altogether. But if you're an equity person and you don't really care about the bond speak, which I understand, I don't agree with, but I understand. Just note that if the short end of the yield curve goes down, it's actually not just necessarily that it goes down; it's the reason why it goes down. Could it be that the new Fed chairman, whoever that's going to be, is going to be lowering rates? Likely, at least that's what it sounds like so far. I don't know. Or is it that investors are starting to realize that maybe the economy is weakening and therefore the Fed is even more likely to cut rates? It's typically, a little basket of things together. It's not just one thing. And so I can only tell you that watching the bond market here is pretty important. So. Anyway, that's pretty much all I have this morning. We'll see you guys back here tomorrow. We have a Market Rover member session coming up here in a few minutes. Then we have a Trender member session. So if you are a Trender member using our momentum indicator, the Trender, make sure you join us. And then tomorrow, this is really important. It's basically, we call it the 2026 AI boom allocation. It's about this big sector, this big rotation in the markets, and within that big rotation, a very specific one that we think we think is really important. So we'll see you guys over in all those other sessions today. And again, hopefully tomorrow you'll join us in our weekly strategy session. Have a great day. And remember, tomorrow after the close, we get NVIDIA. And that's probably going to be